Good morning, Michael.
Good morning, Anna. Let me get my screen up here. Where are we here? Okay, hopefully you can see my screen. Let me audio.
The screen looks good to me. You have 45 minutes.
Okay, great. Thanks, Anna. Good morning, everybody. Happy Thursday. It's February already. Gosh, this year is going by pretty quick. And even though it's only February, honestly, it feels, if you've been involved in the markets this past week, it really feels like, the markets have been trading for several months this year with this whole GameStop, silver, AMC stuff that's been going on in the markets. And what I want to talk about is trading flow-driven markets. And, you know, in this training, I'm going to explain to you what is a flow-driven market, how you can easily determine if a market is flow driven versus a normal technically driven market. And lastly, I'm going to show you how to take advantage of the opportunity a flow driven market provides. And what you saw last week with GameStop, it was a flow driven market, right? It didn't respect the technicals, right? If you've been around the markets long enough, you understand that there are different type of market conditions, right? And you can't trade every market condition the same. You can't trade a trending market the same way you would trade a range bound market. And a flow driven market is basically a trending market where you have just this overwhelming flow of trade, of orders coming into the market that is just going to blow through levels, and you're going to sit there scratching your head saying, gosh, I wish I had got in earlier. And just really brief to discuss who I am, and for some of you guys that are new to one of my presentations, my name is Michael Valtos, and I've got a 25-year pedigree of trading at very high levels, right? I've started on the CME trading floor with Dean Witter Reynolds. I left the floor when electronic trading started taking off. I spent a few years on the upstairs trading desk at Dean Witter. Then I left to join an English trading company called EDF Man. It's been around since the 1700s. After that, I joined Commerzbank, right, the big German bank. I don't know if there's any big German banks anymore, but back in those days in the 90s, it was Deutsche Bank, Commerzbank were the two big banks in Germany. And after that, I joined Cargill, the big American privately held trading company, that trades everything in the world, pretty much. They trade the whole supply chain. They account for about 30% of the grain exports of the U.S. and about 25% of the meat exports. But they trade, currencies, they trade interest rates, they trade metals, they trade oil. They're really into everything. And after Cargill, I joined JP Morgan. And this was in Singapore because Cargill had sent me out to Singapore to set up a trading desk there. And after Cargill, I joined JP Morgan as vice president of futures trading. And I spent 8 years. I left in 2013 after my daughter was born at the end of 2012. I wanted to spend more time with my family. And since then, I've been an independent trader, and I started orderflows.com. Now, I've talked a lot about order flow, right? That's my background, right? Because sitting on a trading desk, staring at the market, on time and sales, on a dome, at the bid ask for, basically since electronic trading really started taking off back in the 90s, I've been watching the order flow. And when I left the firms that I was working for and I was trading for myself, the software that was out there available for traders was okay, but I realized, software can do a lot more. And in 2015, I released the Orderflows Trader, which takes the order flow, in my opinion, to a whole nother level to make it easier for traders to understand. Okay, but I could talk about my background a lot, but it's going to bore a lot of people. Really, the whole point of this is about you, right? I want you to have better trading results quicker, right? I want you to get you up to speed on what's the important things to look at in the order flow as quickly as possible. Now, the charts and tools that I use in this training are generated from my order flow software, but what I'm showing you today can easily be applied with other software that's available, other order flow footprint software that's on the market. If you use Sierra charts, if you use the Ninja Trader, the basic order flow package, or you use Motive Wave or any of these others, what I'm going to show you, you can use that with your existing order flow software if you know what to look for. If you don't know what to look for, it's not going to do you any good. You can have the most expensive software out there, but if you don't know how to use it, what's the point? So I'm going to show you how to use order flow to make better trading decisions. And, for those of you that haven't got a copy of it yet, I'm going to show you how you can get a copy of my book, Trading Order Flow, for free. If you just stick around till the end, I'll give you a link that you can go and download it for free. So time and sales, right, is basically the tape, okay? It's showing you what's traded, okay, and the volume. It shows the price and the volume traded. Now, actually, it contains all the information a trader needs to understand the context of the market. Problem is, if you're looking at time and sales, it's like drinking from a fire hose. The amount of data that comes out is so fast and so quick, it's going to bury you, right? There's just too much. We're not all born in the matrix, right? We don't have computer chips in our head to understand what's happening in the time and sales, right? And you can see on this time and sales here, within seconds, you're trading a lot of contracts, and some are green trades, some are these are orange actually, but the colors matter, right? Because some is trading on the bid, some is trading on the offer, right? And there's quantities that obviously that go with it, but it's telling you as the market is moving up, what's being traded on the offer, or if the market's moving down, what's being traded on the bid. And that's important information. But the problem is most people don't know how to use it, right? It's great information, but again, what's the point of having information if you can't synthesize it, if you can't make heads or tails of it? So traders developed the order flow, basically the volume footprint chart, okay, which takes all that information from the time and sales, what's being traded on the bid, what's being traded on the offer, and put it into an easy to read format on your chart. So you're not sitting there thinking, oh, I'm scrolling through time and sales looking for something. It's all there, all right there on a nice, easy to read chart for you. So before I begin, just a brief disclaimer. Please realize trading involves risk, right? And I think we all saw that recently with this whole GameStop situation, right? There's people that made a lot of money. There's people that lost a lot of money. So just as quickly as you can make money, you can lose money in the markets. Now, markets have different conditions. Okay, another way to think of it is like the rain, right? You could have your normal rain where it's nice, oh hey honey, come outside, take my picture, I'll put it up on Instagram. It's a nice weather. Or it could be, this typhoon type rain, which is like being in the shower. I've lived in Asia for 10 years, and the type of rain that we get there is completely different than the type of rain that we get in central United States, right? I live now in Chicago area, and we don't get these typhoon heavy rains. And the market's the same way. There's times where the rain is nice and normal, where it's just rain showers. It's nice. You go outside. Oh, look at me, I'm in the rain. Or then there's other times you say, oh, guy, there's no way I'm going out in that rain. Now, markets have the different conditions, right? There are normal market conditions, and there are flow-driven market conditions. So, in other words, think of it like this. Don't make too much out of it. It's market's trending or ranging, right? And knowing what condition the market is exhibiting is going to put you ahead of many of the other traders who are just trading the market one way, right? You can't trade a trending market the same way you would trade a ranging market. Now, what's sort of the difference is flow-driven markets, right, which are trending markets. Why do they trend? Well, they have longer-term trading participants involved. Okay, technically driven markets have little long-term trading participants involved. And it's a bit like if you've ever been whitewater rafting, right? You go down the river, it's nice and calm. That's your technically driven market. But then when you start hitting the rapids, that's your flow driven market, right? You're just reacting, you're hanging on for the ride, and you're enjoying the ride. So why does participation matter? Well, depending on who's actively participating in the market is going to determine how a market reacts, right? You're not necessarily trading price. Oh, we traded this price, I got to react. You're trading sort of the reaction by other traders to price. So if there are big traders in the markets, the ones who can really move the market, right? If they are not participating on a particular day, what do you think the market is going to do? Is it going to move very much? No, probably not, right? But if you can notice, right, if you could pick up in the order flow that, yeah, big traders are active, what do you think is going to happen? Big traders just don't buy and trade, buy and try to make scalp 3 or 4 ticks or a couple of points in the market. No, they buy and hold. They buy and put it in their back pocket and wait 3 months, 6 months, right? They're the ones that are expecting the market to move, and their buying or selling is so big that it's going to cause the market to move. So you want to pick up on those that activity when it's starting to happen, right? The best time to get in on a trend is when it's first starting, not after it's already moved. So normal market conditions. Now I'm just showing you a normal bar chart here for simplicity purposes. Markets generally respect levels, the half back level, the 50% retracement, the 38% retracement, fib levels, pivot points, this yellow line up here is the opening price, and you see the market come up, test that, sell off, come up, test that, sell off. Normal market conditions generally respect levels in the market, whereas a flow driven market is a one-way street. It just blows right through the highs of the day, just keeps going higher. This was the Nasdaq a couple of days ago, right? It just one-way street straight up, not respecting any levels, not respecting the high of the day, not respecting the previous day high, not respecting the value area high, respecting nothing. It's just going, right? It's driven by flow. So flow-driven markets have high long-term trading participants involved. Technically driven markets have little long-term trading participants involved. Technically driven markets are driven by technicals, and who trades the technicals are the short-term traders, right? The intraday traders. You don't see big hedge funds looking at, oh my gosh, we have this level here, I can't trade. No, that's not how they think. So who are the big size traders? Well, it's the banks, it's the hedge funds, commercials, the real money accounts, the central banks, people that think, central banks do get involved in the market, and they are long-term traders. They buy and hold. They're not getting out next week. They buy some more, they buy some more. They don't care if the price is going up or down. If they have to buy, they buy, right? But their activity, it shows up in the tape, it shows up in the time and sales. The problem is, for most traders, they can't see that if you're just looking at a normal bar chart, right? Because all you're doing is just looking at traded price. You're not looking at volume. That's why traders go to order flow charts, go to footprint charts, is because it's more useful, and traders are able to better organize the data, right? And that's really what it is, right? It's about organizing data in an easy to read format. The footprint chart, the order flow, it's not the holy grail. It's information though, right? And it's information that you can use to maximize your trading results. So when you think of a technically driven market, right, what is it? Well, it's based on technicals, technical analysis, support and resistance, fib levels, pivot levels, etc. And a technically driven market, is your normal trading day, right? If you're familiar with volume profile or market profile, it's the big D-shape day, right? Because the market is respecting the levels. It respects the high, the low, the value area high, the value area low. It respects the point of control, etc. But you know what? A lot of times technical levels are not respected, right? The market just blows right through them. And oftentimes, traders just say, when a market isn't respecting levels, well, it is what it is. The market's it's not my day in the markets, right? They just chalk it up, say, oh, I had a failed setup here. They don't take the next step further and try to understand that something bigger is at play in the market, right? Because what's happening is it's a flow-driven market. When you have a market that's taking out technical levels one after the other after the other, if you try to get short at new highs on a flow-driven market, you're just going to get loss after loss after loss. Just after, same thing for a market that's falling, right? Keeps falling on a flow-driven market. It's going to keep making new lows the rest of the day. But if you're trying to trade it as a normal technical market, you're always trying to buy that bounce off the low, bounce off the low, bounce off the low. Problem is you keep making new lows and you suffer loss after loss after loss, right? You have to be able to adjust as a trader, right? Trading is all about change and recognizing when the market conditions have changed. And that's where order flow comes in, okay? Now, I'll be honest, order flow is not for everybody. There's people that just can't wrap their heads around it, or there's people that are more longer term traders. Do they need it? No, maybe they're more fundamental traders. Okay, fine. But, for those that are willing to take the time, put in the work, order flow is going to be very rewarding. It's going to help them understand the market. Today, earlier, I got an email from a user, just got the software, order flow software, and saying, it's really now starting to make sense to me, right? I'm finding I'm taking better trades and I'm being able to manage my trades better. So the order flow footprint is going to give you insight into the market that you're not going to see on a normal bar chart. Okay, so this is what is this? This is the Japanese yen. This is a 5-minute chart, right? And the market here is coming down, making these new lows, and then all of a sudden, you got this nice green candle up. You got some buying coming in here off the low. You hit the low, can't go any lower. A lot of traders would see this as a bullish sign, right? Because why? Because you're at the low, you see buying coming in, right? If you're trading as a technical normal market, you're thinking, okay, yeah, we made the low, can't go any lower after 15 minutes. It was a great buying opportunity. But if you're watching the order flow, you would know that, even though this looks like a bearish sign, it's actually not. Okay. And you can see this is right here. This is where the market, the previous chart I was just showing you right here, this little green arrow, right, which it looks bullish, but it's actually misleading you in a sense by following price and what's happening in the price action, and the market just continued to drop another 30 ticks. This is Japanese yen. It just just went lower and lower and lower. But if you're trading, this is my little bounce, it's starting to go back up, I finally got confirmation, I got the green candle. No, by watching the order flow, you would know that it's actually bearish instead. So remember, okay, a flow-driven market is dominated by longer-term time frame traders, right? Think back of what just happened with GameStop, right? It went up. Obviously, there were a lot of short sellers, but one of the reasons why it went up is and it's still up today in the sense that it's still up relative to a couple weeks ago. You have people that are buying it with no intention to sell it, right? Diamond hands, people that don't, they're long-term traders, and generally, other than this recent GameStop stuff, the long-term time traders are the really big money in the market, and they don't respect technical levels, right? They don't think, oh my gosh, this market's too expensive, I can't buy it here because relative strength is off the charts, or the market's overbought. The people don't understand that market could go from overbought to more overbought to more overbought, more overbought to extremely overbought to off the Richter scale overbought, right? Big bankers, they're not thinking, oh, we're coming into a support level, I'm not going to get short here. Flow-driven markets just blow right through these levels with impunity, right? People don't say, well, we're at this, all-time high, I can't buy here, or taking out yesterday's high, I can't buy here. Flow-driven traders are saying, just buy it. They've got orders to fill. So what are levels? Well, there's support and resistance, there's daily highs and lows, there's overnight highs and lows, there's fib levels, there's pivot levels. There's so many different levels you can come up with. It's funny because I was joking with somebody about fib levels. They're big fib traders, and I was telling them, I trade, because they're like, well, I trade a 987 tick chart, or a 612 or 512 chart and stuff. I'd be like, well, I trade the 629 chart. Wow, 629, what is that? Some hidden levels? No, it's my birthday, June 29th. And some of these things, sometimes it doesn't make much sense. So how do we know, right? This is a chart I was showing you earlier, the footprint chart. How do we know that this is a good opportunity to get short, right? Right off this high, right? Because now you finally got some buying coming into the market. Shouldn't you be looking to get long? And some traders are going to say, now this is what happened prior to this chart I just showed you. Some traders are going to say, well, the market has been selling off and it's been trading lower. But honestly, that's a lot of Monday morning quarterback, right? It's easy to look at a chart after the market sold off and look for reasons. It's a bit like Bitcoin. Bitcoin goes up, people look for reasons on why it went up after it went up, or if it goes down 20% in a day, they come up with all these reasons why it went down after the day. And as a trader, you got to make your decision now, right? You can't do after the fact trading. When you're at lows of the day, you got to be asking, Are we going to go lower, or is this it? Is this as low as we're going to go, and we're going to start to rally? Now, this area here, right, in the box, right? So this is the bar chart, just sort of give you an idea. Yeah, the market had been trading lows, hit the low, and then went sideways. Now it's sort of coming back down to that low. Is this low going to be made? And people say, well, it's obvious, right? You look at this chart, it was just going down, down, down. You got to sell it, right? This is what happened in that box afterwards, right? Yeah, the market just sold off another 30 ticks, okay? Well, it's easy to look at a chart and after the fact and say, well, yeah, obviously we had been selling off, right? You come down here, you got to get short again. Well, the day before, a couple of days earlier, we had sort of the same thing. Market traded from the high of the day down into the lows of the day, but it didn't go lower. In fact, it rallied up to new highs of the day. So, it's one thing to look at a chart after the fact and try and analyze it, but in real time, as a trader, you got to be making that decision in real time. You can't trade a chart after the fact and go back in time and trade it that way. So what made this a great short opportunity? Well, if you're looking at the order flow, okay, every time there was aggressive buying on the low of the day, it couldn't build on it. There was very little continuation. Now, in order flow, we have what we call a divergence. Now, there's bullish divergences, there's bearish divergences. I'll get into the details of those in a second, but down here, right, this is from the open. We traded down into the lows. We had two bullish divergences, which should be bullish, right? The market you would expect to rally because what's happening? You're at the lows of the day and you see aggressive buying come in. Okay. What does the market do? It just goes sideways. Are traders getting rewarded for their effort? No, everyone's coming in buying this low, but they're not getting rewarded because the market's not going anywhere. So when we come back to that low right here, we have another divergence. Okay, so now this is your third divergence. Okay. And most traders are expecting a rally again because you have divergence. Technically you should be buying, right? You got aggressive buyers coming in at the low. Now they're doing it again. But the market doesn't rally. Instead, it sells off. And this is a trade setup that I always use to define a trending market. Okay, now we'll get into the details, the specifics about it in a second. But by the time we hit this third divergence, I'm already looking to be getting short, right? Because I've got a lot of bullish information in the market, but I know the market's not rallying, okay? Because who's buying it off these lows? Well, it's a technically driven market. Traders, the short-term traders that, we're at the lows, I gotta buy it, right? That's how people are trained to do. You buy lows, you sell high. And if you're trading at lows, that makes it easy for you because you're at the lows of the day. So remember, who moves the markets, right? Well, it's not just, market isn't just made up of buyers and sellers, right? It's made up of aggressive buyers and aggressive sellers. The traders who lift the offer or sell into the bid. Now, there's also passive buyers and passive sellers, people that work a bid and work an offer. So you got to understand even though there's buyers and sellers, you have aggressive buyers, you have passive buyers, you have aggressive sellers, you have passive sellers. And all this information, these different types of traders show up in the time and sales when a trade is executed, but it also is going to show up in the footprint chart. Now, you and me, we're small traders, right? As you know, we're not going to move the market no matter how aggressive we are. Okay, there's always going to be a bigger trader out there that's going to bully us, and don't get bullied. Just follow what they're doing, right? Follow the big guy that's going to move the market, right? But more importantly, you want to follow the big size aggressive traders. Now let's pause, okay? Because I'm going to get into a little bit more advanced stuff for you guys. There's three building blocks of order flow. There's delta, point of control, and imbalances. Delta is the difference between aggressive buying and aggressive selling. The point of control is the price level in the bar with the most volume. And then there's imbalances, which is when aggressive buyers outnumber aggressive sellers by a certain ratio. Usually it's 4-1, but you could adjust that or more, and vice versa. Okay, so you got to understand some of the data that you're being able to use from the order flow in your analysis. And divergences deal with delta. So delta is, again, it's the net difference between aggressive buying and aggressive selling in a bar. when someone aggressively buys, right? They buy at the market, they lift the offer, that registers as +1 in the delta. If they aggressively sell at the market, so if they sell the bid, if they sell at the market, that registers as -1. Now, every bar has a delta. It could be positive, it could be negative, it could be zero, right? When it lands on zero, it's just more of coincidence than anything else. The strength or weakness of the delta gives traders a clue as to what's happening in the market right now, right? Remember, you got to trade in the present. So delta, right? Most software, Orderflow software, will show it on the bottom, right? And you can see here this market was going down. Yeah, we got negative delta, which is what you expect on a market that's moving down, because it's showing you sellers are in control. But now you start seeing positive deltas, which technically is bullish, right? You're at the lows and you're seeing aggressive buying coming in, right? You see people coming in lifting the offer at the low. Now, sometimes it could be short covering or long liquidation, depending on your highs or lows. But you always got to be paying attention to who's in control of the market. So how do you spot a flow-driven market in the order flow? Well, you look at divergences. Okay, now there's different types of divergences. There's bearish divergence, there's bullish divergence. A bearish divergence in the order flow is when you have a new or equal high with negative delta. So you're at your high of the day, but you have aggressive selling coming in. Imagine you're at your high of the day. If you're expecting the market to go higher, you want to see aggressive buying, not aggressive selling. A bullish divergence would occur at the low of the day, right? It's when you have a new or equal low, but you have positive delta. You have aggressive buying coming in at the low. So, think about it, right? And there's somebody I know, a few years ago, so they thought they discovered the holy grail to the market, divergences. Well, you're at the high of the day, and you see, and if selling comes in, right, aggressive selling comes in, you got to short it. Well, sometimes yes, sometimes no. Okay, and it's important that you have software that's going to highlight that to you to show you when you have a divergence in the market, rather than sit there and try to analyze the market bar by bar. There's a lot of information the market is giving you. Have software, let your software show all this information to you so you could make the decision. You spend your time not analyzing every trade that comes through the market, but rather tell you what's happening based on that trade and let you make the decision. Now, the Orderflows Trader software, my software, I recognize that this was an important piece of information, and my software highlights that to me when there's a divergence in the market, so that I could sit back and say, let me now take this divergence and put it in context of the market. Okay, so this is our Japanese yen chart again. So we got a few bullish divergences here. As the market opened up here, you have a divergence right on the in the same bar that you open, but then you got a divergence, and then a little later you got two divergences. So I know that we sold off. Now I got some aggressive buying coming in, and that's bullish, honestly. Okay. Now a bearish divergence is the opposite, right? You're at the highs of the day, and you have aggressive selling coming in. So you can see here, right? These two bars have this down triangle, which tells you there's bearish divergence, right? You're at the high of the day, you got negative delta. At the high of the day, you got negative delta. That's aggressive selling. But as you can see, the market didn't do anything. Instead, it just made new highs. Well, you say, Mike, you just told me that if I have bearish divergence, the market should go down. But you're showing me examples where the market's going up, right? And it's sometimes easy for traders to get confused because they just take things at face value, right? You got to put it in context of the market. And there's an important saying is, what doesn't happen in the market is oftentimes more important than what does happen as expected. So, what doesn't happen as expected is as important as when something expected happens. So if you're expecting the market to go down based on your analysis and it doesn't, does that mean you're wrong? Well, partly, yeah, you're wrong, but it's also telling you, it's giving you a very important piece of information that, hey, there's something bigger at foot in the market, right? You analyze all you like, but if the market's not doing what's expected, it's probably telling you there's something else going on in the market that's much bigger than your technical level or your analysis is leading you to believe. Everyone likes to say, well, yeah, all the information available to traders is in the market. Well, it's not. There are people that have access to information that you and I and many other traders just don't have and will never have. Now, what I want to talk about though is the flow driven market and how you could recognize it. So you have a divergence and it should either be bullish or bearish, but when you start putting together strings of divergences that are failing, that's a sign, right? That is a sign that the market may be a flow driven market. So what I like to look for, well, I don't go out of my way to look for it, I just see it on the chart, is when there's two divergences that are violated, two divergences that happen relatively soon within of each other, I'm watching for the third divergence, because if that third divergence is going to get violated, chances are the market's going to run. So this was the third divergence right here. Okay, so I had two earlier back here, it's not on this chart, that failed. Okay, because one was a little higher, the next one was on this low of the day. Now I'm coming down here, I got another one. Okay, what I'm looking for, I just put in a stop in right here. I'm not looking for this market to all of a sudden rally. If it does, great. But what I'm looking for, the market's got a stronger propensity to break down. Okay, so I know at this low of the day here, this market keeps pounding down. Okay, every time we got the aggressive buying coming in, it's not enough to move the market. And then look what happens, right? It breaks through that low. You got the heaviest volume of the day. You got a very strong negative delta. So aggressive sellers are definitely in control. You simply put a buy stop, or sorry, in this case, a sell stop, because we're at the low, right below this low of the day to get into your trade. Let the market confirm that, yeah, you know what? It's flow driven. There's bigger traders at the helm that's going to move the market. Just go along for the ride. Now, this was the E-mini chart the other day. Okay, so this is 10:30 Chicago time, right? I've got a divergence here. Well, 10:33, another divergence. You see the market starts to come off, comes back up, makes a new high. Another divergence, aggressive selling coming in. You got negative delta, so I know there's aggressive selling, but the market's not going anywhere. Traders that are selling it here aren't getting any reward for their effort, right? They're just selling it. Maybe they're taking profits, but there's somebody that's happy to buy it, right? Boom, market makes another new high. Up here, another divergence. So I've had 1, 2, 3 divergences in a span of about, about 20 minutes. Okay. So at this point, I'm looking, well, if we're going to break 61.5 or 62, that's where I'm going to be looking to get long, because now I know I've had reasons to be shorting this market that are not working, right? The aggressive selling is coming in after we make these highs, but the buying is just too much, right? People are getting run over, right? So you see, this was the third imbalance here, right here, right? This one right up here at 37.61.5. Does the market move? Well, it starts to go off a little bit, right? It comes off from 61.5 down to 54. Okay, so it's a nice 6-point move, 7-point move, but it's just hanging around, right? You got aggressive selling, but it's not really strong enough to move it anywhere. So, but I'm still interested. If we're going to come back up here, I know I've had aggressive selling, but it's not enough to move the market down very much. If we're going to come back up, I think it could be off to the races. And what did it do? It came right back up here, 61.5, 62, shot all the way up to 77. All right. Buying on the breakout of the third failed divergence. All right, you had first divergence here, second divergence here, third divergence here. I'm just sitting here I just put a buy stop in here. Okay, comes in, fills me, trades immediately, all the way up to 66, 66.5. It comes back. How much heat did I take on the trade? If I'm getting long at 61.5 or 62, it only came back to, what is that, 59.5? 2 points of risk for what? A 15-point winner. So flow-driven markets, they tend to be more fundamentally driven, right? Technical levels are being driven over. See what I did there? Driven. They're not being respected. These technical levels, right? The high of the day is not being respected. Why? Because long-term traders, long-term time frame traders specifically, they have orders they need to fill, right? they don't care about the high of the day or the low of the day. What you're seeing is clear price direction. Okay, here's crude oil yesterday or the day before, the 2nd, February 2nd, right? Divergence, 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 54.75. Okay, now I know this one failed. This one failed. I'm going to be watching to see if this one fails, right? I don't have to get long immediately. I mean, you could always buy a dip, but for me, it's a little safer. Just I put my buy stop in here at 76. Okay, if it comes back up here, takes out that high, I think I've got a good opportunity for a nice trade. And what happens? Boom, it takes out the third divergence right here. Okay, then it puts in another couple divergences. See, the market doesn't do anything. It doesn't really sell off. You're getting long at 76. You're risking, what is that, 5, 6 ticks, right? For what? Long at 76, you can see it just moved all the way up to 91, but a bit later, all the way up into the 55s, 55.10, 55.20, all the way up to 55, 26. Now, I'm not saying you'd sell it right up here, but you're getting long in here. How much risk are you taking? You got a little bit here, he pulls back a little bit here, pulls back a little bit here, even a little bit here. Oftentimes there's a lot of traders would sort of inverse this chart. Imagine, and I know a lot of traders that would get short up here, and it's trading 90. They don't get out thinking it comes back down here to 70. Their entry price 75. They're 3 ticks, 4 ticks in the money, thinking this trade's finally going to work. Comes back up here again. Oh, okay, I'm in the money. I'm not going to cover it. You want to be above this blue line long rather than short from above this blue line. This is the third breakout right here. This is where it happened. The breakout on the third failed divergence. Now here's Nasdaq. Again, on the 1st of the month, just a couple days ago, divergence, divergence, divergence. So 13,197.5, right? I know this is my level. I just put a buy stop in here at 97.5, 97.75, 97, or sorry, 98. Okay, I'm looking for the market to keep moving. Because why? Because I'm thinking that, okay, maybe we're in a trending market, a flow driven market, that there's maybe something fundamentally I don't know that's happening in the market. Okay, boom, boom, boom. You get a 70-point rally off of that. And that's just all by looking at divergences in the order flow. Now, earlier you had a 70-point pullback here, okay, before it started making these highs, but you didn't have any divergences there. Maybe at these divergences, people are looking for a 70-point pullback like you had here, but instead, as a trader, you should be adapting to what's happening in the market. And it's telling you there's bullish flow coming into the market. If we take out this third divergence, chances are it's just going to keep going up and up and up. So hopefully you can see how order flow delta, specifically divergences, gives you vital information as to what can happen next in the market. But again, delta and divergences, these are just parts of the order flow generated information. Okay, you can look at other information like imbalances and point of control, but using order flow is like having a treasure map, right? Now, it's not going to give you the exact route, but it's going to give you the route to know where you should be going in the market. It's going to give you a better understanding of what's happening in the market. And what separates winning traders from losing traders is not having an edge. Edges come in many forms, right? It could be a piece of information that other traders don't have, or something they don't recognize, or something they don't see happening in the market. Order flow gives you that edge because you're going to have information other traders don't have. You're going to be able to see things happening in the market that they're not going to be able to see, like a market sweep, or an stacked imbalance, or a lot of things, or market weakness. So hopefully in the last 40 minutes, you'll agree that this has been time well spent. Honestly, I can't cover everything in a quick 40-minute training session, but I've got a special offer so you get everything you need to know about order flow. And if you act fast, I'll give you a special deal, okay? It's the Orderflows Trader software, right? It's, in my opinion, the best order flow software available to a user. Now, I admit I'm a bit biased. Now, it runs on NinjaTrader 8, doesn't run on TradingView, doesn't run on TradeStation. And what it is, it's the volume footprint chart. The charts that you saw in this presentation are generated from my software. So you can see where there's a divergence in the market, okay? And that's just one of 17 pre-programmed order flow tools, right? I could do 16 more presentations on just each unique um, order flow tool in the Order Flows Trader software, right? That's just one. The divergences is just one little bit of what's available in the software. And it's very easy to set up on NinjaTrader. It takes a couple minutes, basically import the software into NinjaTrader. You don't even need templates because the software defaults are set up to my defaults. And normally I sell this for $8.99. But it's really like, the way to describe it is like taking my knowledge of trading order flow and putting it into a programmer so you can see what the big traders are doing in the market, right? I spent 20, 25 years trading at very high levels on the institutional level. What I did in the markets is being translated into my software. But I realize having software is one thing, you got to know how to use it. And I give you access to a bunch of education, right? I don't just say, here's the software, go figure out order flow on your own. No, because you won't. It'll be a waste of your time. So what I give you is education, right? You give you access to my order flow trading course. There's 20 lessons. Normally I sell this course for $297. You're gonna get it for free. You also get access to my Inner Circle video series, which is 56 videos on advanced order flow analysis, tips, tricks, on reading the order flow. And normally I sell this for $497. You're gonna get that for free. So the software, the training, and the Inner Circle access, that's $1,600, almost $1,700, but you're not going to pay that. But again, I realize that, it's one thing to watch courses, watch videos. What you want is some live action, right? And each week, Tuesday nights, 7 p.m. Central Time, I do a weekly live group training where you can come in, ask questions about a specific market, about something about the software, and I'll answer that with you. So even if you say, well, Mike never answers his emails, every week you're invited to this and you could attend. So, say you sent me an email and I missed it, right? You could come in here and I'll address your issue. Sometimes, people buy software, then you want to talk to the guy. They charge you access for that. I mean, what's that about? So you're going to learn more about order flow in these weekly sessions than you thought possible, right? Because it's one thing to watch videos that came out a couple of years ago. What you really want to know is what's happening right now in the markets. What's the best form of analysis that you can use to understand the markets? So if you add all this together, the software, the training, the weekly live training, it's almost $1,900, almost $2,000, but you're not going to pay that. It's just a one-time payment of $749. What you're going to do is you're going to go to orderflows.com/oft3, right? And it's only going to be $749. There's no more weekly payments that you got to make, monthly recurring payments as some of these softwares out there, they want to bill you forever, make you a customer for the next 10 years of paying $99, $200 a month. No, it's just $749. A lot of traders say very nice things about the software, and how easy it is to use and how you can see what's happening in the market. Sheila says, the software, Orderflows Trader software, is very helpful. I can see what's really happening in the market. So what you got to do, you go to orderflows.com/off3, scroll down, takes you to the button down here. Click this button to get started. Go to orderflows.com/off3. Takes you to PayPal. I don't get your PayPal information. Now, do realize, right, once you pay, the information gets sent to your email that you use with PayPal. And if you don't get it, you should also check your spam folder. Sometimes people forget to check their spam folder, or they use a different email address for PayPal than their regular email address. I don't know your regular email address is different, right? It goes to your PayPal address. But I want to also give you the Order Flows playbook, right, which also has additional trade setups in there, right? Normally I sell that for $297. You're going to get it for free today. So get started now. Go to orderflows.com/oft3.html. I put the links in the chat. There's no monthly payments or anything like that. Just a one-time payment to get started. So what you're going to get is the Orderflows Trader software, trading courses, Orderflow trading course, Orderflow's Inner Circle video series, the Orderflows playbook, and you get access to the weekly live group training. And if you can't attend due to time zones, that's fine. It's recorded, and you'll get access to the recordings as well. So if you want my book, go to orderflows.com/book.html, enter your name and email address, and then click submit. The next page after that will take you to the download. So you can download it to your phone, your computer, etc. So get started, right? In life, you got to get started, right? So go to orderflows.com/oft3.html. The link's in the chat. So Anna, I'm going to throw it back to you guys. If you got any questions, just send me an email, mike@orderflows.com, and I'll do my best to get back to you in a timely manner. So anyway, Anna, thanks for having me. And we got 2 more great speakers coming up after me. So thanks, everybody.
Thank you so much, Michael. Great presentation.
Thank you.
Let's move to our next